welcome everyone. And we are having two exciting Fire Chats today. And the first one is with our featured guest, Gary Rieschel. Let me just do a brief intro. And so Gary is the co-founder and managing partner of Qiming Venture Partners, which is based in Shanghai and Seattle with numerous offices strategically located in both countries. Qiming is a top-tier US-China venture fund with over $6 billion under management and 13 funds, soon to be 14, both US dollar funds and RMB funds. I think with roughly 40 IPOs and counting, and many more acquisitions. Some of the names you may have heard, including Xiaomi, Meituan, and ByteDance, which is the parent company for TikTok. So I've known Gary and his co-founder, Dwayne Huang, for a decade and a half. They both are legendary in building up China's venture landscape as we know it today. Gary is always known for his broad perspective and deep insights. He's indeed one of the most thoughtful individuals out there. After all, Gary is a strong supporter to CatchLight Week. In today's session, I will have a dialogue with Gary for about 20 minutes and leave some time for Q&A. So please don't raise your hands, just use the chat to ask questions if you have questions. So I now welcome Gary to the stage. Gary.
Thanks, Wei. Pleasure to be here.
Great. So my first question is, you came to China almost 20 years ago, and you played a very active role in this special period in China's modern history. Now looking back, what are the overall observations and takeaways for you?
I think that, so the first time I started doing deals in China was in '99 with SoftBank. And so we helped Chauncey Shea set up SoftBank China. Then we set up, I set up Safe Partners, SoftBank Asia Infrastructure, and hired Andy Yan to run that fund. And then with Feng Bo, we did Seiyuan. So by 2004, when I actually moved to China, we'd actually been involved in setting up a few funds. You could sense that you were about to see an institutionalization of the Chinese venture market. So back at that time, it was hard to do diligence. You didn't have a network of entrepreneurs that you'd been working with for decades like you had in the US. You didn't have the legal infrastructure. You didn't have the accounting infrastructure. So everything was pretty raw. But when you look at the market and you look at the appetite that the Chinese consumers had for technology, you looked at their increasing income. You looked at the just insatiable, desire and curiosity. So you could predict that the market was going to be successful. Venture capital would be successful in China. I think I would say I was surprised at how quickly that occurred. Starting in 2005, you went from having a handful of firms to having dozens of the top US firms, mostly under their own brand, like Sequoia, Matrix, and so on. They came to China. Qiming was a little bit unusual in that we were establishing a new firm and a new brand. But the things that you could sense was what was going to happen in the overall market. That part was very clear. We set up a healthcare practice because, to me, you had the same situation in healthcare. Healthcare, it was only 2.3% of GDP in 2005. It couldn't do anything but go up. So that was also not difficult to predict. What was difficult to predict, and you start to understand, what are the big differences between what are the easy mistakes to make? So there's just a handful I would mention. One is understanding the Chinese entrepreneur takes more time. We didn't, in the US at the time, it was quite common, and it is today, to replace CEOs. If a company's not doing well, when you bring in a more professional management, that we found was virtually impossible in China. We also felt that the entrepreneurs in China relied so much upon their network of relationships because, again, the legal infrastructure, everything was new. So they needed to have this network effect of being able to sense when changes were coming and then pattern recognition around what was happening in the market. So they had to deal with a great deal of ambiguity. And because everything was happening so quickly, they had to deal with ambiguity at high speed. Most US entrepreneurs things are so much better defined. The market's better defined. The community in which they work was better defined. So you had a great deal more uncertainty, but you had this churn. You had this activity level. Um, I find it. I think most, to me, people in Silicon Valley thought that they worked hard. Um, I don't think anyone works harder than the entrepreneurs in China, yourself included. At the time, I'd get calls 10 o'clock Sunday night. Can we get together? I said, sure. When do you want to get together? Now. Really? So you'd go meet entrepreneurs at 10 o'clock Sunday night. That was not uncommon.
Mhm.
And so during that period, there was just this enthusiasm, almost as if the entire entrepreneurial community in China had decided it was their time.
Mhm.
And so that's very rare. And in fact, I would argue that only maybe Israel, but Israel is so small. There's a handful of countries that have ever experienced that. I think also when you look back on the last 23 years since 1998 of venture capital in China, the other thing you have to realize is virtually all the risk capital, so all the true risk capital, not late stage, not pre-IPO, almost all the risk capital was in dollars. So the vast majority of money that created the Chinese ecosystem or supported it really was in dollars. So that's an interesting observation when you talk today about decoupling
Mhm.
between the different economies. The Chinese government has actually done more decoupling than the U.S. government, by blocking enterprise software companies, restricting access to the markets. But what they're finding is it's hard to replace the risk capital that exists in dollars with RMB. Most of the Chinese investors, because they're not as technically in, this is changing, obviously, but for most of the last 15, 20 years, they're not as technically astute. And so they don't like to take that really early stage technical risk. So it's interesting that most of the money that's helped create this incredibly successful ecosystem in China came in dollars, not in RMB, not local currency. So those are some of the big
Mhm.
differences. It's very hard to replace CEOs, the ambiguity in the market, and I think the role that the foreign capital played in actually establishing a very robust
Mhm.
and healthy ecosystem.
Right. So I completely agree with you. I was in the trenches for a few years. And one other thing that's consistent with this is I noticed that, how Chinese entrepreneurs are so willing and eager to do the bare knuckle competition, right? They don't hold anything back. And they also are not afraid of copying everybody's idea right away, right? So I came back to the U.S. a few years ago, and the behavior here is more gentlemanly, right? They don't blatantly copy people's ideas, but not so much concern in China.
Yeah, I think I think partly that's cultural,
Hmm.
and it's also when the Chinese market evolved very quickly. So what took 30 to 40 years in the U.S. happened in 10 years in China.
Hmm. Yeah,
So nothing gracious is going to happen when you put that much capital with that many
exactly.
people in
Right.
such a short period of time. That just uh, it wasn't inevitable, but that is definitely how that market evolved.
Right. Yeah. So these are some great observations. Very, very true. So there's also some observations, if we have time, talking about the Chinese consumers, right? They're also a little bit different than the U.S. consumers, especially over the past 10 plus years. But that's another thought. So if I move on to my second question. So Gary, you came back with a few of your colleagues a few years ago, and you guys quickly established yourself in the biotech and in the healthcare sector. So what prompted the move, and how would you compare investing in the US and in China?
So what prompted the move was quite simple. China could never be home for me. And so at some point I turned 60 in 2016, so it was time to think about going back and being in the U.S. again. I'd spent 5 years in Japan earlier in my career, and 12 years in China. So I felt that that was enough. Plus, Qiming, the management team in Qiming had matured very nicely, and one of the things we did in the very early days of Qiming is having a dedicated healthcare team. So as that matured and became successful, that gave us some information. It informed us as to, oh, when you go to the U.S., hundreds of firms that are doing exactly what Qiming was doing in China. Healthcare, we felt that certain dislocations were about to occur. So the emergence of gene therapy, the emergence of cell therapy, these were relatively new, but they had an opportunity to change a significant part of the healthcare infrastructure. Same thing on digital health, that the application of analytics, data, et cetera, was going to also materially change how drugs were discovered and how patient outcomes were improved. So we made the decision that Qiming in the US, the first foot in the US, should be healthcare. And then no one else came from China but me, but it was a question of what's the right team. And we've been very lucky. So a partner, Mark McDade, I've known Mark for 39 years. And Mark and I had been at business school together. We always talked about working together. He had done a couple startups. Those startups had been successful. He would run some large pharma operations. And when we started talking, he said, well, this would be interesting. So he came on as the co-founder. And then we've hired a couple really it's not hard to be smarter than me in healthcare because these MD, PhDs from UCSF and Oxford and so on, they're just so smart. But healthcare, the risk is very different than tech. In tech, if I build a software product and I get it wrong, I can usually modify it before I run out of money or before the business collapses. Biotech, cell therapy, if you get the pathway wrong for this particular molecule or this particular therapy, you're dead. So in the US in particular, you have to disproportionately weight the skill sets around the technology capability and analytics and evaluation of that in the early stage. And we've been fortunate enough to put together a team that's been very, very successful at that.
I understand that years back, the healthcare sector is relatively small within Qiming, and now it's more than half of the Qiming footprint. Right. So this is mostly driven by the activities here, right, in the US.
No, it's mostly China. So on the last Qiming fund, which was $1.2 billion, they'll invest it relatively quickly, under 2 years, and close to 60% of that fund is in healthcare. And those are all Chinese investments. What's really important to understand is in 2005, there was exactly one new novel compound approved in China. One. And that included companies that were bringing products in or companies that were developing them in China. It's now hundreds, 300 to 400. So there was no innovation in China's healthcare system back in the 2005, 6, 7 timeframe. So you've really seen the creation of an innovation engine in healthcare because most of it has been backfilling for the need that was very obvious in the Chinese market. So you didn't need to be that creative. You could take what exists in other places and apply it to China. What's happening now is on medical devices, we don't do medical devices in the US. And the reason is the Chinese medical device industry is as good, as innovative, cheaper, faster time to market, same level of quality. So to compete against that in the US doesn't make sense. Yet China has not yet caught up on the cell gene therapy area and some of the more advanced therapeutics. But it will happen. You can't have tens of millions of brilliant people, provide them enough money and a whole bunch of sick patients. You can't have that combination and not have innovation occur.
Right. So I remember the early days, right? You mentioned you initially came to China in 1999, but settled in 2004. But in early days, I remember everything we did in China was C2C, right? That's translated to copy to China. Then 10 years later, you start to hear kind of idea of CFC, right? Copy from China, maybe 15 years after that. So it's really representative in quite a few sectors. And I'd love also to hear your high-level comment on, the basic research and then the applied research development versus deployment in comparison to these two countries.
Right. I think that, for the longest time, we would get this, what I thought was a very stupid question, which is, can China innovate? And if you were living in China anytime in the last 20 years, the innovation may not have been in the way that you were thinking about it in the US. But in terms of the business model, the consumer behavior is what drove a lot of the innovation in China. Back in the 90s, the consumers in China were not that selective. Just good enough in China meant it was probably pretty mediocre. Well, over the course of the last 20 years, just good enough in China is good enough for anyone in the world. And so that's a fundamental change in terms of what the consumers expected. And that drove a higher quality bar and drove more concern about innovation and the quality of the product and services being delivered. I think the core R&D in China is, even despite lots of patents and things, to be honest, I don't really think the core R&D is a strength yet. Part of the problem is that the Chinese government continues to waste a lot of money putting R&D dollars into SOEs. And they don't have the incentive, they don't have the infrastructure, and frankly, they don't have the people.
I had firsthand experience in that, so I agree with your assessment.
So they just don't have the right ingredients to have a very innovative, large corporate sector. So that's going to take some time. But when they allow experiments to occur, like in fintech, and they allow experiments to occur in different sectors, whether it's autonomous vehicles, you see this explosion of creativity in China at a very, very high level of quality. And I think that the government can't help itself. It's going to, the US government has the same problem. They'll try to pick winners. They'll try to protect certain vested interests. The reality is, you never want to get on the wrong side of the Chinese entrepreneurs. It is as you were mentioning, it is a ferociously competitive environment. And the U.S. firms, when they run into it, they have to up their game. It becomes a very, very tough competition for many of the U.S. entrepreneurs.
Yeah. So I agree. One of the companies that you guys invested, ByteDance, TikTok, which is a company under them, really had given us a sneak preview, right? This is a big topic, but we can learn so much from this story. How the Chinese entrepreneurs develop their product and open up the market or develop the market and their audience. But then the missteps they also had and the learnings they had, the quick adjustment they were doing. I just find the whole chapter very fascinating. So,
well, what's interesting is when you look at the mistakes that Chinese companies have made when they've come to the United States, a lot of it comes down to trust. When they hire someone to run the U.S. operation, that person isn't part of their inside core group. And so when that person relates needs and things back to the Chinese team, there's always a disconnect in terms of how you trust that person. And so the more discreet the product, like a cell phone or the TikTok video is actually quite a discreet product, you can build that trust more quickly. Complex systems, many of the Alibaba, the e-commerce and payment systems, those things require different levels of sophistication and trust. And so I think the adoption rate has been slower as a result of that.
Definitely.
But what's surprising to me, why should we be surprised that a world-leading company comes out of China? I mean, I find that almost pathetic that U.S. investors or people start to say, well, now these companies are coming out of China, something's wrong. We should expect that. And that's something that's going to happen more and more and more. And what that means is you're going to have to become, for the U.S. firms, they're going to have to become more competitive. And you better not be looking, to me, I hate the fact when you look for the government to protect you. What Facebook did against ByteDance and TikTok, I mean, I'd be embarrassed if I was Facebook.
Yeah, doesn't it remind you of what Baidu did to Google, in China?
Well, and yeah, it does. And I don't have a lot of, I don't have a lot of respect for that behavior. I just don't think that, I don't think it's good long-term for either China or the U.S. to have that situation. But it's, most of these guys, most entrepreneurs in the U.S., they have refused to work with the government. And then all of a sudden they have a problem with the Chinese companies. So now they look to the government for help. I think that's sad.
Yeah, that's very true. So moving on to the next bigger question, bigger scope question. So serious challenges emerge between US and China, and particularly in technology sectors. What do you think are the top issues that caused the deterioration of the relationship, and what does it take for the US to stay ahead?
So this is exactly along the lines of what we were just talking about. There's a sense that somehow because a Chinese firm is becoming very successful, that somehow they must have cheated or they must have somehow done something that was inappropriate. And the Americans have to grow up and get past that because in some cases that may be true, and but in many cases now it's not. And so there's just that fundamental mistrust of, well, how did this company become so successful? The second biggest issue is the U.S. entrepreneurs and many of the U.S. government officials, they believe that China is successful because there's a centralized planning function that is dictating the development of all these technologies. Anyone who spends any time in China realizes the central government is not telling Alibaba, Baidu, Tencent, and the thousands of other successful companies what to do. In fact, the Chinese policy is frantically trying to catch up with what these companies have been doing for 10 years. And so, again, there's a disconnect there. I was part of a group that Eric Schmidt put together, and we created a paper called Asymmetric Competition. It was a roadmap for competition between the US and China in technology. The person we wrote the paper for turns out to be Anthony Blinken, who's now Secretary of State. And the conversation around that paper came down to, yes, all the things, we're not going to change China. It's the US that has to change because the US for the first time has a true peer competitor in many areas. The US market used to be always the largest market. So if you're the largest in the US, by definition, you became the largest in the world. That is changing in many different areas. So the US has to get better and it has to look at itself and make some significant changes. Yes, there are things China is going to have to stop doing because China also can't play the card now. Well, we're poor little China. Okay, that's bullshit. The poor little China part's done. Now it's time for two adults to sit down and realize they both need to play more fair. But
I totally agree.
The US is not going to win by trying to tell China, well, don't be as good. That's
right.
That's not how competition works.
Yeah. So reciprocal came to mind, right? The word. And Gary, I may even share some of the stories when I work at eBay. The unfair treatment occasionally, and then especially when I worked at Google China, right? It wasn't really fair. Yeah, I agree with you. There are things, we just need to have some common rules that both parties, both sides that need to follow.
I think that's exactly the right way.
Right. Yeah. So last question for you, Gary, is for some of our investors and allocators, they're still interested in continuing to invest in China. Given the geopolitical uncertainties, what thought would you have to impart to them?
Well, the geopolitical uncertainties are, thus far, they have not affected the ability of offshore money to invest in China. So there have been discussions around public company investments and whether U.S. pension plans should be investing in public entities. But no one in any of the administrations has thus far said that endowments and foundations should withdraw and pull out of China. In fact, I would make the case that if you want to understand what's going on in China, you better be investing in China because otherwise China is going to become a black box and China would be a much more dangerous competitor if you view it that way to the United States if it was a black box than the way it is today. So I think that what you have to be, but you also have to be realistic that investing in certain areas. So a Chinese hedge fund trying to take a large position in Palantir, probably not the best idea. So you just have to be practical that there are certain areas, just as in the U.S., just as in China. I mean, Qiming in the dollar fund trying to invest in a core media company in China, it's just prohibited. So I think in each of those areas where it's prohibited, you'd almost look for the reciprocal agreement in the U.S. and say that may wind up being prohibited. And so I think there's just that quid pro quo that investors have to pay attention to. But clearly, if you look at where there's going to be exciting investments and returns coming out of China for the foreseeable future.
Yes. Great. I was mesmerized by your answers, and then I forgot to time it. So looks like we ran out of time for the questions. But there is a question in the Q&A, if you can see it, Gary. If you don't mind, maybe just type the answer to the question, and I will provide my perspective to the question as well.
So the question is about the recent government attention in China to the large platform companies. Well, one can actually ask the question why it took them so long. Similar to why you'd ask the question in the US. Gee, Congress is just waking up to monopoly power in the advertising market, a duopoly between Facebook and Google. You're just waking up to that now. And it reinforces the entire feeling about how government is a trailing indicator when it comes to technology.
I think so too.
Tencent, Alibaba, this is not any big secret. Now, we can psychoanalyze Jack Ma to death, and we can psychoanalyze Pony Ma and notice the difference between how Alibaba was treated and how Tencent's been treated. But I think fundamentally what it comes down to is it kind of snuck up on people. Suddenly Tencent's worth twice what China Mobile's worth. Alibaba's worth twice what China Telecom's worth. All of a sudden, those numbers became real. When Ant filed its financials and they took apart the Chinese equivalent of the S1, and suddenly that became visible. Someone did the calculation and went to the leadership and said Jack Ma is going to be worth $200 billion or $150 billion. And they all looked at each other and said, well, we don't have a piece of that. And so I think there was a kind of a shock of it had run away from them. And I also think that when you look at the ecosystem in China and you look at the incredible tentacles that Tencent and Ali have in particular, they've invested in nearly 60% of the 200 most valuable companies in China. Google, Facebook, Amazon have invested in 7% of the equivalent companies in the US. Mm-hmm. So the channel concentration that those two companies have established probably needs to be taken apart, because it's stifling entrepreneurs, and it's making it very, very difficult for any but the largest players to actually be successful. So that part I think needs to be addressed.
Great. Great answers, and I will bring up my partner, Greg, and you and I can have endless conversations over numerous issues, but I really appreciate your coming up and share your thoughts, Gary.
Well, thank you. Congratulations on CatchLight, guys. You guys are off to a great start, so thank you.
Thank you, Gary. Okay, I'll move you to the audience. Yeah.
Okay, Tom, we've got you. There we go. There we go.
Tom.
Excellent.
Hey, nice to see you guys.
Nice to see you. So let's see, Wei, I don't know if you can self-demote.
I'm trying, so don't mind me, just go ahead.
No worries. Okay, so let me just kick off with a little background on our second special guest. I'm actually going to briefly share my screen. There he is, our man, in fact, with Secretary Mnuchin and his family, of course. So Tom is the first Assistant Secretary of the Treasury for Investment Security, otherwise known as the leader of CFIUS. Tom knows his way around DC. If anybody does, he does. He's got expertise in national security, cross-border investment, international trade, government investigations, and of course, technology. He's respected across the aisle. He's not a politician. He is somebody who knows what he's doing in spades. His nomination was approved on an overwhelmingly bipartisan basis. He's got the experience. During his time at CFIUS, he led the review of more than 500 cross-border transactions totaling over 400 billion in value, including some of the largest in the committee's history, and had to deal with some very heavy cross currents in situations such as TikTok, which we just heard about. Both before and after his time in office, we've had conversations with Tom about what CatchLight does to help gracefully untie the somewhat awkward knots that exist now between the US and China tech ecosystems. He's been kind enough to share his thoughts with us before and after his service. Tom is now, after leaving government service, the founder of advisory firm, the Rubicon Advisors. And if anyone on the call would like to connect with Tom, please email me and I will put you in touch. So thank you again, Tom, for joining.
Thanks, Greg. It's great to join you tonight, and I really enjoyed that first conversation. That was fascinating.
Well, and I'd like to particularly thank you since it's late your time, DC. We mentioned to our earlier group that the world is small, but we haven't yet been able to shrink the 24-hour clock. So again, thank you. So I wanted to start maybe with a little level setting. We've got a range of folks in the audience today in terms of their background on CFIUS. Could you give us a quick summary of the CFIUS mission and then how that's changed over the past couple of years?
Sure. So CFIUS is one of those strange Washington, D.C. acronyms, the Committee on Foreign Investment in the United States. It's a cross government interagency committee, 9 voting member agencies, what you would expect. It's exclusively focused on national security. It's led by the Treasury Department and has Department of Justice, Department of Homeland Security, the Energy Department, and their singular mission is to look at cross-border transactions, investments inbound into the United States for national security risk, and to assess that risk and then respond to it, mitigate it, or prohibit the deal in some instances. And the biggest change over the last couple of years really is this statute, this law called the Foreign Investment Risk Review Modernization Act of 2018. The short term is FIRMA. And FIRMA essentially, before FIRMA, the committee was largely a voluntary, almost exclusively a voluntary process. So filers would, in the interest of getting a safe harbor letter from the government saying there's no risk here, you can move forward with your deal. The new law brings in some potential mandatory filings, but also changes the type of deal that can come under consideration. Where it used to look at mergers and acquisitions, it's now looking at mergers and acquisitions where a foreign investor got what the committee considers control over a deal to minority investments, non-controlling investments where a foreign investor may be getting access or to data or technical information that's highly proprietary, or to sensitive data, or to access to critical infrastructure. And the real gap here that FIRMA was trying to address is the venture capital investment, the small investment where there may be some risk of an adversary getting into a company early and accessing information or technology that the government is concerned about protecting. And the other piece that the committee that FIRMA addressed was real estate transactions. There used to be no way to look at a greenfield investment on undeveloped property near a military installation in the United States. So a foreign adversary could buy undeveloped property outside of, for example, Nellis Air Force Base and put up monitoring facilities, and there was nothing the government could necessarily do about that. Those are the big changes, really, in terms of reach and a little bit of a change with respect to no longer is it just a voluntary filing.
So following up on the reach, I think at one point you told me that you had hired 88 of the 90 staffers, maybe on the day you stepped down. So that is a remaking and a growth, I presume, of quite substantial proportions. What was it like? Was it a few folks on the beat, if you will, when you joined, and how would you characterize the team's activity level, dynamism today?
Sure. So when I joined, there was about a dozen people in Treasury. You have to remember that with 9 member agencies and the national security staff and the economic council staff at the White House and a number of other the intelligence agencies that participate, there really is even prior to my joining a lot of depth to and breadth of the number of staff involved. But at Treasury, as the chair, there really was a beefing up of capacity and a retooling of missions to the remits of FIRMA. And so it was an overtaxed agency, overtaxed, no pun intended, at Treasury in terms of that group and their focus and managing the deal flow and the filings and getting them done in an efficient way. CFIUS is supposed to run against a statutory timeline of 90 days. That's a recognition by Congress and the executive branch of the need to move quickly with respect to business deals. I know in the VC space, 90 days or 180 days is way too long, but for the government to think through risk and to quantify risk and respond to it, that's the timeline. And the committee couldn't keep up prior to FIRMA. So the growth of the team was largely to respond to the expected and anticipated increase in filings with new jurisdiction, and then also to build out a team to enforce post clearance work of the committee and the agreements reached between the parties and the government in some cases with respect to mitigating risk. And then also an outreach and policy team to work with international partners and allies. You may, and other folks participating tonight may be aware, but this idea of investment screening for national security has proliferated around the world. The UK just finalized a law very much like ours, a complete retooling of how they will look at inbound investment. Australia, Canada, Japan, the EU, all in the last couple of years. And my team had a lot to do with benchmarking and helping some of these partners and allies develop their own systems. So there's a team that does that, a team that works on the filings, and then another team working on enforcement. And the experience and diversity of that staff is very broad, very talented, a lot of international policy experience, a number of technologists and engineers and scientists. We've really built out a terrific team there.
That's obviously a testament to your leadership, but also, of course, the Congress's release of resources, giving you more capacity, human capital capacity, and so on. You talked about enforcement and filings along the way. One thing we've noted is that even this year, in the few months that we've had this year, we've noted an increase in kind of the retrospective enforcement. You've got now the capacity not just to keep up with, and speaking of you, obviously in CFIUS mode, not just to keep up with the new filings that have come in, which I understand may actually have lagged expectations a little bit. People are maybe not filing as much as folks might have hoped or expected, but that allows them to then go back after so-called non-filed transactions back in the day. Could you talk a little bit about that?
Sure. So one thing I'll say on that front, the rules became effective. I don't know if you can hear, but we're having a massive thunderstorm here, so hopefully that doesn't disrupt this. The rule actually went into effect, the new laws implementing regulations, in February of 2020. That happens to coincide with the pandemic, the full force of the pandemic, and that impact on business and deal flow, and so it's really hard to say, whether we saw as much as anticipated or not. But I will say, during calendar year 2020, the committee had a record number of filings. Never before had something close to 330 deal filings, which is the most the committee's had in a calendar year. And so I do expect now, as we come out of the pandemic, that will continue to grow. In terms of reaching back to deals that didn't file with the committee for whatever reason, or post-closing deals, there is a real concentrated effort by Treasury, by that enforcement team, to look for transactions that might be within our jurisdiction that, for whatever reason, did not seek a clearance, a safe harbor letter, and I anticipate that work will continue to grow.
Got it. So, how well do you think the venture and startup communities understand CFIUS requirements at this point? I know you're not allowed to say what you're doing, which is, kind of ties both hands behind your back in some respects.
Yeah, that's right. I mean, the point of CFIUS being confidential is to ensure that filers really are transparent with the government and share as much about the deal and the details of the deal as possible, so the government really can get a fair understanding of where national security risk may be. And so there are criminal penalties with respect to disclosure of anything related to a filing submitted by the parties. And so that does sort of create this black box notion and feel. But to your question, I don't think the venture capital community really has gotten religion on CFIUS, or what it means, or how it really is going to impact that ecosystem in the years to come. And part of that, I think, is the timing of the implementation of the rule and the pandemic, and just a need by the committee and Treasury to sort of make sure they're engaging with external stakeholders, working with folks like the Venture Capital Association and others to talk about what it means and where risk could be, and how this committee could be extremely disruptive to an investment post-closing if folks haven't thought about it ahead of time.
Do you see any changes under the Biden administration to the trajectory overall, maybe just a little bit on the edges, or anything more substantive?
Well, I don't see a dialing back, if that's where what you're wondering. I think, if anything, the committee will continue to gain momentum in terms of its aggressiveness and its the scope of what it's scrutinizing, and there was a Wall Street Journal article earlier this year that said there was somebody quoted from the CFIUS bar, I think, saying that a lot of there'll be more penalties for failures to file or other sort of CFIUS enforcement activity in the coming year. I'm not so sure that's true, but I do think the committee will be very aggressive in looking at certain types of technology investments, data, and the use and collection of data will be an increasing focus. I think you saw that in a number of cases last year. Health data, data of the general population of U.S. citizens, and infrastructure will also, especially coming out of the pandemic with issues related to supply chains, and supply chain integrity and resilience are certainly the buzzwords for 2021. And so I think you'll see anything that has a cross current or touches on supply chain, and it will get the attention of the committee.
As the committee, looks to maximize its impact, do you think it's going to, at some point in the future, kind of rise up from the company level and maybe go talk to investors directly that might have a portfolio with multiple situations that might need looking at?
So the typical way the committee talks with investors is requesting a filing, requesting what's called a notice or a declaration related to a transaction, and those under the law, and the committee very focused on adhering to the rules that it's promulgated, are done at a transactional level. The committee's intended to be a precision tool as opposed to a policy tool, and so it's very much a totality of the facts and circumstances related to a particular investment in a particular U.S. business. And so in terms of elevating, perhaps that outreach and that policy team will increase, stakeholder engagement and maybe have conversations at portfolio levels, but really its main tool of action is the filing. And so I'm not sure you'll see that change in the near future.
Okay. Speaking of forecasting, do you think that there's any chance, even over a longer horizon, you've been around again in national security for quite some time, you see the bipartisan nature of concerns around these topics in DC. As you put your thinking cap on and you look in your crystal ball, in the next few years, do you see any of this reversing?
No, not at all. No, I think in many respects you're just going to see some increasing momentum. The Congress is very active right now. I'm sure folks have been paying attention to the Endless Frontiers Act and a number of other pieces of legislation that attempt to address this strategic competition, if you will, with China. And so I think you're going to continue to see a proliferation of responses in a number of respects, whether it's further fleshing out of the new Information and Communications Technology and Services Rule. And, the Commerce Department has subpoenaed a number of companies with respect to enforcement of that rule. It was a Trump administration rule. And the fact that subpoenas have been issued by the Biden Commerce Department indicate just a continuity in many respects with a number of these initiatives. So I think that will all continue.
You made reference earlier to the fact that the UK and some of our Five Eyes allies, Japan, EU, and so on, are starting to put in place similar programs. Do you see those starting to coordinate more closely, perhaps over this horizon?
I do, and I do because that at least as long as the United States is driving it. I mean, I think that's part of FIRMA's intent was to increase that benchmarking and cross coordination and information sharing. And so when I was there, we established a number of memoranda of understanding with 6 or 7 of our partners and allies on precisely that. I think from the government's perspective, if the United States squeezes on, it's like squeezing on a balloon. And if CFIUS gets stronger and better at screening investments for national security, and you squeeze on the balloon here, there may be an attempt for an adversary to look somewhere else to exploit that same technology or that same data set and invest elsewhere. So that coordination will grow, I think, in the coming year and years.
Let's see, we're coming up on the bottom of the hour, and I do see a Q&A, but I will ask one question. You can refuse to answer if you want, but any good stories coming out of the political cross currents you found yourself in perhaps last year? TikTok comes to mind, which was not the low profile process perhaps that you're used to experiencing.
Yeah, CFIUS is kind of like that movie Fight Club. The first rule is you don't talk about Fight Club. I'll let TikTok and what's in the public domain speak for itself. I think what's interesting is that the committee is very rules oriented. The Treasury worked hard as the chair to ensure the integrity of the process, because I think, by ensuring integrity of the process and the deliberation and a very rigorous, what's called a risk-based analysis, a very fact-intensive process that also relies on the intelligence community to feed information into that. All of that, builds a process that is deliberative, sometimes can get messy, but in the end, I think comes to the right result. The thing that's interesting is this notion of consensus, I think, and how that will develop in years to come. Historically, the committee has been one where it's been unanimous in its decisions, but the law and the rules have a mandate of consensus. And so while certainly unanimity is a type of consensus, it's not the only type of consensus. And so to the extent, you get into sticky cases in the future, tough transactions, there's an open question in my mind as to whether there will be an increasing sort of development where the committee is intractably divided, and will the the cabinet level officials, the principals, move forward with clearance or prohibition of a transaction when that unanimity is not present. And but that's not really drama. That's probably too far in the weeds for the audience, but nothing crazy political or otherwise to share here.
Okay, just I think back, actually, as my first time as investor exposed to CFIUS was in 06, 07, taking a large company through the process, and it was very much like engaging with the SEC. You filled out the paperwork, and very methodical, to your point. And so drawing the contrast now that the kind of stakes are higher, it has been notable. So fascinating to see. So we're down at the bottom of the hour. I do see one question coming in. Obviously, if anybody has any other ones, please get them in as soon as possible. The question is, given our repeated failures to attract real concessions for IP protection and market access from China, not even to mention government-sponsored hacking initiatives, how do we make China, quote unquote, play fair? And could CFIUS play a role in this?
So the first part of the question is a broader policy question that I'm not sure we have the time to tackle here. I mean, I think it's a whole of, I'll say this, it's a whole of government approach. And I think there are a number of tools, not just, national security tools, but economic security tools that could and should and have been, brought to bear to try and level that playing field. I don't think CFIUS is the right tool for that because, first of all, as I mentioned, it's very focused on a deal by deal sort of process, and it's exclusively focused on a national security assessment related to an inbound investment. And I think that's good, right? There are other tools in the toolbox that can address the misappropriation of IP or the lack of transparency or the failure to or you know the cyber intrusions that the question referred to. So I think it's CFIUS is not the right tool for that. You know, one thing too, Greg, we might not have had time to talk about, but I did want to flag that there was a question we had talked about ahead of time about outbound investment and into China, and whether, you know, there might be some activity by the government in that respect, the U.S. government going forward in terms of you know, regulation. And your timing couldn't be better. There's actually a bill that was introduced by Senators Cornyn and Casey yesterday to the an amendment to the Endless Frontiers Act that would essentially create a reverse CFIUS for outbound investment into foreign adversary countries. It's extremely broad, and it would be a mandatory filing for any investment in certain critical technology or infrastructure or supply chain areas designated by the government. And so it'll be interesting to see how that develops, and could be another new tool in the government's toolbox.
Yeah, indeed, that is a new one even to me. We've been tracking, you know, 3, 4, 5 bills working through Endless Frontiers, which I think may be renamed, but you know, very broad kind of whole of government approach, you know, coordinating across CFIUS as just one of the tools. But interesting to hear about that outbound, you know, the quote unquote outbound CFIUS potentially developing. I think particularly in the wake of Gary, the conversation that we just had a moment ago with Gary, you know, highlighting the importance of, you know, US dollar risk capital to China. Of course, that's benefited US investors greatly, and yet also has benefited China in a certain way. And so, you know, I could see that having an impact on their portfolios. You know, we spoke to an investor the other day who said they've got 20% of their portfolio in China. And so I could see, you know, that not sustaining if the outbound CFIUS comes into play. So
Yeah,
with that, we are a couple minutes over. So grateful to you and to Gary for joining us this evening. Really appreciate your time and your insights. For our investors still with us, thank you for your partnership. For all the attendees, thank you for your time and interest. Please reach out to us again if you'd like to connect with Tom, and we'll connect to you. Obviously, reach out to us if you'd like to learn more about what we're doing at CatchLight. With that, I think we'll end today's session. Enjoy the rest of your day. Wei, anything I've missed?
No, thank you, everybody. We're grateful for your time.
Thanks, everybody. All right, have a great
Tom.
day, great evening.
Thank you. Happy to be here.
Thank you. Bye-bye.
Bye-bye.